Good day, everyone. Well, as you can all see, the markets have come off quite to an extent, especially on the Nasdaq, which is pretty much coming to its all-time low levels off the peak since January of 2013. I think the worst period it's had since then, prior to this one, had been in May and June of 2013. We're seeing a lot of the leaders that just have been pummeled, and they continue to get pummeled. There's a lot of oversold action going on. So the question is whether these leaders will start to want to bounce in earnest, and that'll also probably precipitate a bounce in the major indices. Whether that bounce is dead cat or a resumption of the QE uptrend remains to be seen. In the meantime, the model is on a sell, but it is watching very closely to see if the market does find a floor around the current levels. We did get a spike in the put call close to near 2.0, and those types of spikes can often mean the market is about to find a floor. But it's also possible that that institutions are using that as a hedging vehicle. So at any rate, the model will continue to look for a potential floor being put in, and we are also looking at the major precious metals and commodities, gold and silver. Gold's been up through this mess, but part of that could be driving the fear trade. And if you look at commodities overall, the Commodities Research Bureau CRB index, that's hitting that's been hitting basically new annual highs right around 310. So higher commodities argues for more QE, or potentially a well, the other flip of the coin argument is that the global recovery is actually occurring, and so countries like China will exert more demand on commodities, and thus driving the index higher. Again, it could be either one. I would say that since QE is firing on all cylinders, that does have a tendency to drive hard assets higher, like CRB indices and related indices. So in the meantime, let's continue to watch the price volume of the leading stocks in the majors and see where this market's going to take us. Gil?
Yeah, today looks to me like another double dip Friday. If you guys recall, last Friday we were doing the webinar, and I was pretty well distracted. I talked about that on Sunday when I did my special stock hunting webinar, because I had covered my shorts in the morning because you got the break, kind of like you did this morning. You got a nice break this morning. Things kind of stretched to the downside. I covered some stuff. Usually if I get a big gap down move in the morning and I'm short anything overnight, I will cover some. Maybe a third, maybe a half, and then kind of hang out and see what's happening. Last Friday I'd covered everything and was back in cash. The market looked like it was turning up, and then as it started to roll over, I'm scrambling to get short again. Today you have a similar situation where we saw the markets come down hard, and a lot of these short sale targets I've been hitting, and I know a few of you on the chat room have been doing pretty well with them as well. They came down hard, so they bounced. You had the put call ratio almost. I don't know, did it get to 2? Dr. K, I saw it at like 1.94, and that's pretty high. But you know what I thought was interesting is that was like at 142 or something like that, and then it was rising as the market was bouncing, which seemed kind of odd to me. Usually you'll see the market breaking to the downside, the put call spikes, and then that's like a fear bottom. And what it looks like to me is that it may be something like 2008, where you had really volatile intraday action. This is September, October of 2008, if any of you recall that period. It's a great time to be short. But I remember you'd see the market go down big, and then it would rally back positive, and the put call ratio would be rising. And I was wondering if that, at the time, whether that wasn't institutions hedging by buying puts because they were looking for something worse. And in fact, we know now that that bear market was pretty bad going into November. And so I was just wondering, today you might get the same. That might be the same phenomenon. You're seeing these stocks starting to roll over again, and the market's rolling over again right now. I'm showing the Dow just punching below minus 100, Nasdaq's down 2310. the put-call ratio, somebody's asking, well, you can go to the CBOE website, or you can, if you have eSignal, I use eSignal, and that's the only place, I look at it. And the symbol is $ Peter Charlie Charlie Eddie dash Sam Tom. So $ PCCE dash ST. And that's the equity put call ratio. So that's where I watch it. Right now I'm showing at 1.46. I also look at the index put call ratio, which is $ P as in Peter C E dash ST. So it's basically the same symbol as the other one, the equity put call ratio, except one less C. So one is PCE, one is PCCE. Anyways, I hope that helps. But other than that, you're going to have to look around and see where you can find it. So I know everybody thinks we're some sort of reference book and we know where everything is, where you can find information on everything. But all we know is we've got it on our systems and we know where to find it there. So anyways, I'm actually in the middle of working Gilead this morning. If you notice, I'm going to get to this in a second. Just let me put something out here. Okay, let's give me a second here. Let's check a couple of things. Okay, all right. Where was I? Yeah, okay. Let's look at some stuff on the short side. I mean, everything on the long side is toast, and it's mind-boggling. You know, you would think that with something like Workday, look at that break to the downside. You would think something like this, might muster a rally, higher, but all it does is go up to the 200-day moving average and then rolls over to new lows. So on that premise, where you're seeing stuff like that, here's Gilead. If something gets within 1% of moving average, like the 50-day or the 200-day after it's busted, that zone, within 1% of the moving average on either side, and it could be a couple, 3% as well, I'll come after things on the short side on rallies like that. And so I'm hitting this today. If you look at this, just give you some idea of how I'm playing. You can see LinkedIn has issued a sell signal on the 620 chart, and it looks like it's going below 160 to me. Here's Gilead. You're just starting to get the signal, but I was hitting the MACD stretch up close to 69. Up here you can see the MACD lines stretching the upside right around 740 my time. And now we come in, and now we're starting to roll over. So it looks like it wants to go lower. We'll see what happens. But that's probably going to be a market function. You have news out today on Gilead that they're, what's the name of the drug again? Sapodil, or what the heck? I don't know. They're a hepatitis drug. Probably some of you know. Right, Merck has a drug. So does AbbVie. So there are other hepatitis C drugs out there. So Gilead isn't the only one. Of course, it's expensive as all hell, and so there's going to be some controversy about whether the government's going to want to pay for it. But there's a lot of competing products, so the idea that it's a slam dunk big seller for Gilead isn't necessarily there. That's why the stock's broken down off the peak anyway. So all that's kind of old news. But stock rallies up in here, so I'll try and hit that on the bounce. If it stops me out at the 200-day, that's fine. I'm running a tight stop on it. Another one I've been looking at is Tosco. You got Head and Shoulders. Here's the big break down the right side of the head, and so you rally all the way up. Yesterday you were up around the 50-day moving average, where I thought it was a short, and so far it's working. I got that one out short. LinkedIn, right up into the neckline. If you draw a line, let me see, I'll get forget it. If you draw a line, imagine a line along these lows, and you broke out to the downside, and you rallied right up into it. That was also the 10-day moving average here. So that, for me, is a short area, and I hit it there. So far it's working. I'm looking for it to break the lows again, but I'm still short that from this morning. But overall, nothing can get a bid. Oh, here's Facebook. It's trying to hold. But, Dr. K, is this a buy? I mean, would you buy this because it's cheap?
Yeah, that's the red dress theory, right? From the original.
Buy just like LinkedIn, it's cheap too. So, but this is a violation of the 50-day, so this thing's out of play on the long side until you see some sort of a buy signal. Otherwise, forget it. But, it's mind-boggling. A big stock like Facebook just keeps getting pummeled. It looked like it was going to rally. You almost had, notice how you have a low here. I think that's like 57, 97 or 98, something like that. What's the low? 57.98. Yeah, there it is. And you undercut there last week, and then you rally back up this week like you're going to come out of here, and you got some good volume. So if you're using like a shakeout plus 4 or 5, 62, 63 would roughly be a potential buy point. But notice how it just moves up above there, and then yesterday you reverse on heavier volume. So they're still selling this turkey. And so, you know, this thing has some issues, and it may need to build a base, or maybe it's topped for good. I mean, that's a pretty nice move. And you're starting to look like you're getting some sort of head and shoulders. I would think it would get down to the 200-day to finish out the head, and you'd have a flat or a descending neckline, but we'll just have to see how that one plays out. So let's see here. Got any questions? Anybody have any good questions? And no dumb questions, please, coming from the chat room denizens. I know some of you plot before the webinars telling each other, oh, ask Gil a stupid question or ask him this stupid question. I know what you guys are up to, so don't even try it. Go, in-flight Wi-Fi not working good for webinars. Video okay, but audio very choppy. Well, that's Go. So, but Go is a Go short as far as I'm concerned. Head and shoulders type formation rolling downward. It looks to me like it's a bust. Probably headed back to 10 bucks. The thing is, I think what's going on here is the market is sensing higher rates. If it's 6 months down, Dr. K, how far ahead would you say the market would start discounting higher interest rate environment? Several months, right?
Generally 6 to 9 months. So, you know, the market's very good at that. So, you know, we're in April, and it's telegraphing maybe that we're going to see higher rates early in 2015.
And I think in a rising interest rate environment, the movement into lower PE stocks, and you notice the selling out of these high PE, high flyers, as I call them, it's just brutal, and it's just persistent, and it's just nonstop. It's like somebody is in a big freaking hurry to get out of these stocks, and you can just go across the board, data, workday, you know, throw them out there. Look at P. P's been a great short if you've been following on the chat room. Was shortable yesterday on a beautiful rally right into resistance at the 30 level, and then it busts back below the 200-day. Now rallies into the 200-day at around 27.36 here. We become shortable moves, and you'd use that as your stop. But I mean, this thing looks pretty ugly. Here's your left shoulder, big head. So you're getting close to a point. If you draw, you know, a lot of these things usually it's a descending neckline, so in other words, sloping to the downside. So if you draw one like this, here you come up with somewhere around 23, 24 might be where it stops before it tries to rally and form a right shoulder. But so far on the weekly chart, there is no right shoulder because you've been down every single week. So market coming off a little more, down 106.29 on the Dow. So yeah, it's just like last Friday. It's a double dip for short sellers. It's a double dip Friday, as I call it. Any other questions? My view is I think you could test this low here on the Nasdaq. That's where you're headed, and that'll hit the 200-day. So you may undercut this low and hit the 200-day moving average. That would make sense as a spot to generate a big old bounce. But this action, I mean, this is brutal, right, Dr. K? We haven't seen this kind of selling in leading names since 2011, actually. November of 2011 was the worst month for the Nasdaq until yesterday. And so you've had, you know, reasonably benign sell-offs on a relative basis until yesterday.
2012. Yeah, November 2012 was the Nasdaq falling more than 10%.
Okay.
On its peak. So it looks like it, you know, it very well could reproduce that. Certainly, if we break below 8%, we're probably heading to sub 10% territory.
So right now, how far are we off the peak right now?
Right now, we're still we're just over 7% off the peak.
Somebody asked, what's a good question, I think, does the H&S or the head and shoulders pattern apply to index or ETFs also? I don't apply it to indexes. I don't think head and shoulders patterns generally work on the indexes, but you will notice on the daily chart of the Nasdaq, you're forming a left shoulder and then this big head, but also notice. And so it would make sense that you would come down, if you drew a neckline along here, it would come down and bounce off the 200-day moving average. That looks like a logical area of support for the Nasdaq initially, and then you see where we go from there. I think you're headed into a longer-term thing. That's just what it looks like. Just the way that money has persistently and methodically moved out of high PE stocks and into these low PE high flyer or low PE big caps, not high flyers. And you know, they're safer, more stable names. And it's, as we were likening it yesterday in the chat room to the Titanic. If you saw the movie The Titanic, initially the ship starts to sink. So that's the market. And everybody scrambles up the ship trying to climb up the rapidly sloping downward deck. And they're running to the other side of the ship, the back side of the ship, because that's the side that's still up as the front end starts to go down into the water. So institutions moving into defensive stocks, the lower PE, some of the semis, some of the big caps on the Dow, oil names, food names, etc. That's like everybody running up to the back side of the ship as the nose goes into the water. And as that starts to descend into the water, well, guess what? Even those who ran up to the top of the ship, you know, in the back part of it that's still above the water, they're going down too. And then they'll all let go, like Leonardo DiCaprio in his last scene in the movie, where he's holding on to the piece of floating wood with his girlfriend, his new girlfriend, and then he just kind of lets go and slides off into the depths. Anyways, that's kind of my Titanic analogy for the market here. But that's kind of what's going on. And so people think that, oh, you know, there's this movement. If you don't see the movement into defensive stocks, then you're missing what's going on, because you can see the movement. And having advised institutions for ONeill when I was there, and you, Dr. K, we used to go out and see these people all the time. We know how they operate. We know that they'll move to defensive names because they know the market's going down. They just want to be somewhere, given that they have to be fully invested all the time, okay? They're not allowed to try and time the market. So they have to stay fully invested. They're going to move into the areas that they think will go down the least. And so the way that they've moved out of these high PE, high flyers so persistently, and just, you know, the selling is just off the charts brutal, it tells you that there's a shift going on. And so that's why I think the Titanic's probably going to sink entirely. But we'll see where it goes. Playing it on a stock-by-stock basis has been very nice on the short side, and just don't get piggy. Set your price targets and stick to them. So initially, my price target on Pandora, also known as P for pounded, was a 200-day. So you cover as it comes down in there, let it bounce. You short again yesterday, right at resistance, and the 10-day, boom, it breaks for you. LinkedIn, another one that undercut. You can see that on it was was it Monday? Yeah, Monday. It undercut the low of this base. See that? And that triggers an undercut and rally. Everybody sees that as a breach of support. So shorts come rushing in, and they can squeeze them for a couple of days, which they did. But it took it right up into the 10-day moving average. And as I pointed out earlier, if you draw a line along this neckline, to me this is kind of this is like a double head here. You know, and it's not. These are patterns. You're not trying to label a pattern as being this or that is kind of pointless. But you can see the price volume action as it rolls over, and so it's got the general head and shoulders feel. Even if you wanted to call these double heads, a fat head and then a little mini-me head over here on the right side. But you can see the big selling off the peak, boom, boom. And as you're coming around, the rallies don't have as much volume, but the selling picks up volume. It tries to get going here. You stall here. Then the volume picks up and you break again. Then you rally here, big volume on the upside, but it's a big stalling week. And then you roll over again as you run out of gas the next week. So you come down and you break to lower lows here, and now you're bouncing up. But you can see how this is sort of a rolling top head and shoulders with multiple right shoulders. So, but you know, we've known LinkedIn's been a piece of garbage for a long time. So let's see, more questions. Tesla is holding up so far above 200. When the market turns, has a good chance for heading higher. Well, I would say anything that gets oversold to a point where eventually the sellers go away, you can get a sharp snapback rally. I don't trust Tesla any more than I trust anything else in this market, because this thing is a high PE, high flyer as well, and it could just keep coming down. So if the market turns, I don't know if I'm a buyer here. If it had held the 65-day exponential, you notice how it tries to hold it here 1, 2, 3 times, and on the third one, it finally busts through. That doesn't look right to me. So I'm not, you know, if the market turns, I'm not just going to jump into certain names, because you think because it's holding the 200 level right now that it's going to have some big move. Didn't really get going yesterday. Early in the day the market was up big, but it really didn't have that big of a move, and then it reversed hard when the market did. So I don't think you can assume anything. And then you guys want to get into the shakeout plus 3. The only problem here is with a $200 stock, you're using about a shakeout plus 17, 18. Dr. K, what would you use on this shakeout rule for a $200 stock? Would you use a certain percentage? Would you use a number of points?
You always want to always keep it in context, so percentage, never a flat number, because obviously a $200 stock is different from a $30 one.
Right. What kind of percentage?
Yeah, I mean the shakeout plus 3 rule is generally based on stocks priced, in a traditional zone when that rule was created, which was between 30 up to 90.
Right.
So if you were dealing with 200 stock, it's more like shakeout plus 6 or plus 7, plus 8, something like that. Just keeping it in proportion.
Right.
Yeah. And some of these stocks these days are priced in the hundreds. And they're not splitting. I think it's an interesting trend that we see in a lot of the leaders that they're saying, okay, we're just going to just keep the stock running, and then then you're seeing $700, $800 per share prices on many of these names. So the shakeout there obviously is going to be in proportion to, say, if you're a $700 stock, it's going to be shakeout plus 30, not shakeout plus 3.
So Tesla is setting up to be a shakeout plus whatever. I'm going to say at least 10. And then probably closer to 15. My view is, you might get a pocket pivot through the 10-day or the 50-day, and that would be within range of the price move you'd want to see for a shakeout plus X, where X is the number of points you're going to give it. But I wouldn't be bullish in this market. I've been amazed every time. That they're just sitting there like Humpty Dumpty, ready to take a big fall. Well, they probably already have taken a big fall. And now you got all the king's horses and all the king's men trying to glue them back together again with some cheap super glue imitation. But it just, there's nothing to buy, so forget it.
Yeah, the question is, I guess, also where does QE start to disconnect? Because all this fake wealth has to have a price tag that comes with it. And if you look at some of these stocks that are just, they're up ridiculous amount since 2009 when QE started, and if they're going to reverse that massive uptrend that they've experienced, we're looking at a massive correction that we haven't seen in a long time, many years, if not a couple decades. So that's the question: is are we going to, first of all, QE? It could continue. We could see a resumption of the uptrend, and that could go for another 6 to 9 months as the tapering effect or the rise in interest rates keeps getting postponed because the global economy does not recover, and then the central banks have no choice but to keep printing. And meanwhile, it's a frustrating environment because it's highly manipulated. On the other hand, if the market really believes rates are going to be going up in 9 months, and some of the air is being let out right now, the selling wave we've seen might be the start of a much larger selling wave, because the markets can be quite unforgiving, especially for something as pernicious and manipulative as QE has been. If you look at Priceline, for instance, that's a stock that's been a leading stock since 2009, and it's interesting that the last 3 weeks you've got a lot of selling volume in this leading name, as institutions are, I guess, in some ways it's considered a safety net because it's such a huge cap stock, but on the other hand, it is a high-flying one. So I think more institutions are telegraphing they don't want to be exposed to such a name in this kind of environment. And if more, if things keep coming off, eventually it's gonna hit stocks like this. Are going to reduce in price quite substantially to renormalize to a non-QE environment.
Mm-hmm. Somebody asks. Hold on, I'm just checking a couple things here. Okay. Somebody asks, once the Nasdaq hits a 200-day moving average, do you look to play the old leaders, or are you looking for new blood now to go long into? Who knows? You have to see what's going on when the market hits the 200-day, assuming that it does that and doesn't just go right through it. So there's no hard and fast preconceived idea of what you're going to do I'd have to say, outside of having a plan on a few names I'm looking to get short, I don't know what I'm going to really be playing heavy on any given day. So, that's not the way the market works for me. You're watching what's going on in real time. You're going with the flow, and you're taking opportunities as they show up in real time. So who knows? There's a yes, I'm going to go out and buy 50% Tesla, and I'm going to buy 50% Facebook, and yeah, that's my plan. How do you know? We have no idea. So, I'll slap you around on this idea that in advance what's going to happen and what you're going to do, because you don't. And unless you're willing to stay flexible on that, then give me 1 second here.
So there's going to be some names, not in this kind of market that we're seeing, where everything's getting taken out, but there will be some leading names that may buck a downtrend, and of course those you want to have on your watch list. You want to watch those closely, because when the market starts to recover, then those often are the ones that are going to lead the way. But that doesn't really apply in this market. I don't see anything out there that is really bucking this trend. Everything's getting taken down pretty hard, and that Tesla really has been one of the de facto leading stocks, but that too, that's looking at 22% off its peak. So there's really very little out there that looks right for the picking once the market turns. You just got to see on that day, and do keep your watch list going, because we certainly keep ours going on a day-to-day basis.
Right. So anyways, and who knows? Well, we'll see. So just go on the chat room, follow us on Twitter, whatever. Your thoughts on this being similar to spring 1994? Who cares? I don't care what it's similar to. What I know is it's exactly like April of 2014. So that's all I need to know. I don't have any thoughts about that kind of BS. I think all of that is just BS, okay? This looks like such and such a year, and so what does that tell you? Does it provide you with some sort of a roadmap that tells you exactly how to operate? Does it tell you exactly what stocks to be short? Does it tell you exactly what you might want to buy if the market does turn? No, it's pointless. It's mental masturbation. And I know that ONeill likes to popularize that stuff with the precedents and all. And yeah, there are some precedents, but they're only valid, in my view, in terms of overall sort of the macro thematic picture, if you will. Like with you look at, say, Tesla, and we came up with the idea that Tesla was similar to General Motors in 1915, and not necessarily in terms of the pattern, as if that's some sort of a roadmap that you're going to be able to use to manage a position in Tesla, with precision, but as showing a thematic basis and a similar sort of technical move that could occur in Tesla based on certain precedents that are in turn based on underlying conditions. So get away from this idea that certain periods can provide you with roadmaps, because they can't, okay? And you have to be trading and watching things in real time and responding to the information as it hits your screen in real time, So that's really what I want to convey there. Do you expect the S&P will substantially increase its decline here, or will be more shallow compared to the Nas? Well, another crystal ball question. Is my aunt going to grow testicles and become my uncle? Maybe, I guess, and there might be some probability of that occurring, but it's that kind of a question. Do you expect the S&P? Who knows? Is it going to go down more? It's probably going to go down more if the whole market goes down, and leading stocks keep going down. So, but who knows? Again, somebody says, Gil, Titanic is a fantastic analogy. I think it's pretty accurate. Let's see. Gil, thanks for the insight. Can you share a few tips on how to adapt HCS to find names that are seeing the rotation? No. I mean, I don't adapt it to anything. I just look at, I've actually done webinars for HCS, and you should probably go to their website and look at them. They're instructional on what I look for. And if you look at the stock hunting webinars, you can see the lists that I go through looking for stocks. So there is no, I mean, you see the rotation when you're running your normal screens. So on a daily basis, we're seeing stocks like FireEye and Data and Workday and Facebook getting smacked, and LinkedIn getting smacked, Tesla getting smacked. But you're noticing the names that are acting well on those particular days are Constellation Brands, Coca-Cola, Procter & Gamble, oil names like ExxonMobil, Microsoft, big cap, big technology stock. Yeah, what were you going to say? So, that's really the message there. I'm just looking at things every day in real time. So, somebody asked, Dr. K, you ready? Dr. K, what are your favorite ETFs to short the indices? I would say inverse ETFs, but that's just my wise-ass answer. What do you have any preference from where the markets are now?
Well, you want basically, on these sell signals, you want to be in indices that are showing pronounced weakness. So that would be Nasdaq Composite, Russell 2000, and not the S&P or the Dow, simply because those have been holding up because they have a lot of the super cap or defensive value-oriented posture. Therefore, always go for the weaker indices. You don't have to stick to the list that we provide. There can be some others that have been showing pronounced weakness, and those are fine to go short on as well. And of course, we're looking at foreign ETFs. In some cases, we've recommended foreign ETFs, but keep in mind that those tend to have more volatility associated with them. So on a risk-reward basis, we often will stick with the U.S. ETFs.
Here's another question. Sorry, but some of us out here are buy and hold guys. My quick answer to that, then that means you're idiots, because if you're buy and hold in this environment, you're just going to end up getting slaughtered. But moving on, what do you think about buying high-volume small-cap ETFs on the way down? Explain, buy at the 100 DMA, 200 DMA, etc. How about a long reply? I don't understand what that means. Buying a small-cap index?
High-volume small-cap?
I don't know. I don't understand that question. I think trying to buy anything on the way down without seeing when the market's actually turning is just dumb. And
I think what he wants to do, since he's buy and hold, he wants to do the dollar cost averaging thing. So, in other words, the further the market falls, he'll continue to add to his position, because on the idea that at some point the market will reach the floor, and if you don't have the time to do anything but buy and hold, and there are people who do that, I mean, you're crazy if you just buy and sit and don't position size or use any kind of strategy. You are better off. Let's take a really bad example of, say, 2000, March of 2000. Let's say you've been you bought a position in March 2000, and then the Nasdaq cratered something like 78% from 2000 to 2002. But if you've been buying dollar cost averaging all the way down, then you would reach a break-even point quite a bit sooner by doing that. So I mean, just looking at this, if your average cost in the Nasdaq, I mean, I'm looking at a monthly chart now, and it's nothing but wreckage, 2000, 2002. But your average cost on the Nasdaq might be something like 2,400 by a dollar cost averaging in. It certainly wouldn't be 51.32. So therefore, you would have actually reached the break-even point, and you're now well in the money, but you'd reach a break-even point about 10 years later. 8 to 10 years later. So it's still, of course, that's one of the worst situations. You could take another one like 2008, and if you dollar cost average that thing, and your average cost was 1850 with QE at the helm, and that ferocious bounce that indices experienced in 2009, you would have been you'd have broken even actually inside of a year. So if you're kind of looking at that kind of scenario, and you got to buy and hold, and you're thinking, okay, we might get another horrible, situation on our hands. That's sharply. Well, actually, that's the other thing is if we did get another horrible repeat of something worse than 2008 or something on par because of all this fake wealth that's been created, there's absolutely no guarantee we're going to see a repeat of the bounce of 2009 to present. I mean, that was hugely manipulated by QE, and I don't see the Feds being able to replay that scenario again. They'd have to figure out something else. I mean, I personally think that you wouldn't get the bounce. You'd get a lot of mayhem in the markets, but I don't think you'd see such a sharp recovery at all.
Right, and you don't know what kind of recovery you're going to see.
Where, that's the thing. And we've had times in history where you got these horrible periods that just, went nowhere. I mean, if you look at 1966, that was a market top where you had, my gosh, your break-even point from 66 would have been, just looking at the really long-term chart here. Gosh, it goes way back. I'm going to have to adjust my screen here. Yeah, if you look at 1966, you would not have broken even until 2 decades later.
Right.
Or so it's just you got to be really careful with this buy and hold strategy, because sometimes there's periods in history where you're going to be out of the money for many, many years.
Yeah, I mean, I don't see why you'd want to do it. I would think a buy and hold strategy it's better if you're to be like what Livermore talked about, the man from the mountain who would come out the mountain every so often and place his orders because he recognized a big macro trend starting, and then he would buy his stocks and then go back to the mountain and then come back later, go back up the mountain rather to his cabin. And the idea there is that he was able to identify when a major shift was occurring, and so he would get on at that point and then sit long term. And that was sort of a buy and hold approach that I could go for, assuming that that's a market that's trending smoothly. But I don't think you can just blindly buy into a dip and expect that it's going to work. You could get really decimated. I don't advise it. I don't think it's smart. Somebody says if we hit this
hold would have actually been brilliant in the QE environment, and like Gil was saying, there are the moments where you could possibly just take a huge risk and just say, okay, I don't have time to follow this, and start buying at the start of QE, or when QE certainly showed itself in earnest as something that's going to stay.
Right.
Stay for a number of years. And I mean, there's other periods that buy and hold. I don't know, just lots of. If you look at 2003, if you started buying, or 2004, you had a lot of flat markets, and your buy and hold strategy would have been, the profits in that would have been reversed in half of 2008. You'd be flat, and then you'd be well down. And not only that, the other problem with strategy is when people start to lose a lot of money with markets cratering like they did in 2008, they run for the hills usually at just the wrong time. So you might have been back in cash toward the end of 2008 at quite a big loss on your hands, not knowing that QE would propel the markets much higher.
Somebody asked, if we hit the 200-day on the NAS and we do get a bounce, is this where we may start to see pod develop? I mean, pod isn't a pattern that applies to an index. So, in a punch bowl of death is a big, deep cup where you break down hard and then you rally back up towards the highs and then you top at the highs. So there aren't any patterns that I see like that. And on top of that, it doesn't apply to the indexes. So I would go back and read the chapter 6 in our book, the first book, the yellow cover, to get a better idea of what a pod is. But you have no idea. Again, it's a crystal ball question. Are we going to see this happen? Are we going to see that happen? How the hell do you know? You don't. And that's fine. I don't need to know. I know what's going on right now. Markets in a downtrend, stocks rally into resistance where they can be shorted, and then they roll over again. So, that's the way it's working right now. What would be the scenario with the institutions that caused the market to move up on the Yellen comments the other day? I don't know specifically. It's not like I got a hotline into institutional investors, so I know what they're doing. But the rally on Wednesday looked like a short covering rally to me. Market's down deep. That uses an excuse to rally. But all rallies in this market, if you notice, have been alibi-type rallies where the market's getting hit and there's some news that's used as an alibi, to justify a rally. And I think what happens is everybody gets really short in here because they see everything breaking down. Everybody probably wants to get short today, and so the movement today, intraday, is probably just a process of shaking them around and messing with them and forcing them to cover because your positions really are just sitting on the fence. There's nothing really breaking down outside of a few names like LinkedIn's coming in a little more here. I see down under around 167, but only down about $3. So I think this is short covering. So I don't think what institutions do is they use a rally like this to sell into. So. Assuming that we do bounce at the 200-day, what do you buy when all of the leaders' patterns are broken? Nothing. Again, assuming. What happens when you assume? So there's nothing. Who knows what you buy? If you think you can play things off the lows, then you might try and play some spring off the lows type rallies. If you look at something like a price line, once it undercut this low, you could have traded that, but you better be in and out of that thing in a hurry, because if you sit too long, you're just giving it all back. So it's not clear. You have to wait for the market to set up and heal, and then you'll see leading names. So it's not like you jump in, the market turns, you jump in, and you start buying like some mindless fool. So you don't want to be doing that. Again, you don't know what's going to happen, okay? And you don't necessarily, just because stocks are coming down like Priceline here, doesn't necessarily mean that that's going to be the one to buy, or that FireEye, because it's so deep down, that's going to be the one to buy. Look at this bounce. That didn't last very long. And this thing just keeps going lower. So, and every time it tried to turn up, it looked like the market was trying to bounce, and it didn't. So you don't know. And I wouldn't worry about it. When the market gets to a point where you might be looking at buying some stuff, you'll see us putting out alerts on stocks that are buyable, and you'll start to see pocket pivots in leading stocks, maybe even as the market is still correcting, just like we saw back in, I think it was the summer of 2010, Dr. K, when we were in New York right after the book had come out. I remember, and I was on Fox, and everybody was pretty bearish, but we were seeing a number of pocket pivots in leading stocks right around the end of August, and I went on and I was actually bullish, remember?
That was a great time because there were so many setups that were emerging, and yeah, I remember that at that point, the world was quite bearish on things.
Yeah, it was the end of the world, and the people I was on TV with were, they couldn't see how multiples justified a, rally, blah blah blah, and all that. So that's probably what you'll see. So it's going to take time. It's not like you're going to jump in and buy, and the market's going to magically turn around and you make a ton of money on anything you buy. The S&P 500 today appears to look very similar to Nasdaq March, April 1994. Guess what? If you go back and look at charts of the Nasdaq and the S&P going back 100 years, you're going to find all kinds of years that look similar. Like I said earlier, it doesn't mean diddly squat. And if you think that you've got some kind of a roadmap that's going to help you navigate the market with some sort of precision, you're on drugs. So forget it. And, just forget all that stuff. Don't even send me questions asking me, does this look like 1929 or 2002 or 1926 and, whatever. Who cares? Who cares? If you sat around looking for, what the market looked like so many years ago, back in early March, you wouldn't know what to be doing with the stocks that we were going short at the time. So, is it based on rates? I'm going to let you answer this one, Dr. K. Is it based on rates or Fed action alone, or is there just a breaking point to the psychology of a bull? The Fed was easing in both 99 and 07 when things came apart. That's not true, actually. The Fed started raising rates in early 2000, right, Dr. K?
Yeah, that's exactly what created a lot of problems. Was that they said that the market's ahead of itself. We're going to slow it down by raising rates. They did what the Fed did in 1929. And that derailed the whole bull. Yeah. Back then and in 2000. So there's no level at which I've studied rates backwards and forwards, and there's no real set level. It's more the tendency of how aggressive they become. The speed of the acceleration, if you will, when they're raising rates, and how many times it's been happening. But there's so many factors. There's the strength of the economy, and are they raising them in conjunction, in context with where the economy's at, and how far has the market's come. There's many variables associated. So I think you drive yourself crazy if you try to find some hard set rules that apply to interest rates. Right. Again, it's a search for some sort of certainty in the market, or some sort of a deterministic approach that creates certainty in your decision making, which does not exist. Is the 65-day exponential moving average a common institutional moving average? I don't know. I know commodities guys have used it, and I have some friends who use it, and that's how I started using it. And then all I did was start putting it on my charts and observing how stocks act around that moving average. That's all. I don't know whether institutions use it or not. There's a lot of different moving averages. The 100-day is one. The 150-day is another. There's all kinds of fun, exciting moving averages you can use. But again, moving averages are just guides, and so the idea that you're going to use a moving average as some hard and fast, area that you buy or sell at or whatever, is again just not rooted in the reality of trading, which is that you have to watch what's going on in real time. So, energy plays seem to be working. From your experience, does it make sense? From my experience, energy plays are defensive in the down market, and eventually they'll go down with the market. So yeah, I see the FANG is moving today, and it's trying to break out. And you also have this Athlon. This little Athlon is kind of cool, little name, and it's acting well. So they're doing okay. But does that mean that I'm going to jump into them necessarily? No. In my experience, when the market goes down, eventually everything goes down. So you're better off waiting. Now these stocks, if they hold up, and you notice they are, Athlon and FANG are holding up the basis. If the market turns, maybe this is where your leaders are going to be.
and it may not be exciting, but it may work. Market's just getting bumped around here, bounced around. Doesn't look like anything too, other than coming down lower. But the put call ratio now is 1.39. It's been declining, so we'll see how this thing closes. Somehow it seems that Tesla misses the volume for a shakeout plus 10. Well, I wouldn't even worry about it. Tesla is not something I would be buying, and you're looking, it lacks the volume. Of course it doesn't have any volume because it's not doing a shakeout plus 10. When you see it start to move, look at the volume then. But you're trying to anticipate something that is not showing up in real time. So I think that's kind of silly. Bill ONeill looked at markets in 2000 comparing it to 1930. He was dead right for 3 years. Well, I was at ONeill at the time. Okay, so we were dead right, I suppose. But yeah, you could see that we were in a bubble market, and you had a massive breakdown. But could you use the chart from 1929 to guide your trading in 2000, 2001, 2002? No, and that's my point. If you think that you're getting some sort of a roadmap that you're going to be able to operate in the markets, and no, yeah, you can base a bubble market like we had in 1929 similar to 2000, and guess what? It broke down the same way. And that's not, to me though, that's great. Okay, so the market could break down, but so what? You play it on a stock-by-stock basis, and that's why I think fixating on it as if it's some sort of a roadmap that you can use to navigate the market with some sort of precision, it's a bunch of BS. And I always thought Bill overemphasized all of that stuff. The other thing is, they sell it to people, and people being dumb and lazy, they want something that's simple. They want it to be spoon-fed, some easy method that they don't have to think too much about. So if you can somehow say, oh, look, the market looks like it did in 1929 or 1994, I can just do this and it's all going to work and I don't have to think. To me, it's just an excuse for not thinking in real time and understanding what's going on in real time and understanding what opportunities there are based on what individual stocks are doing. And it's just a completely different way of operating. But I think the problem with ONeill emphasizing what happened in the past is, yeah, it provides, as I pointed out with the Tesla and General Motors precedent, which we talked about, we wrote about it in Forbes when Tesla was down around 70, 80 bucks, 90 bucks. And that turned out to be dead on. But does it give you an exact roadmap for how to handle Tesla? No. So, names that are up like FANG, do you look to short because of this market weakness? Go back and read Chapter 6 of our book again. What do we look to short? We look to short stocks that are breaking down, that are showing weakness, where the flow of institutional money into these stocks has reversed course. So, somebody calling me from Kissimmee, Florida. What the heck is that? Probably some cold caller. Gil, thanks for the smack in the chops. You're welcome. My pleasure. Question for Dr. K. Oh, but let me get back to, with stuff like FANG, like I said, if these are holding up, if the market turns, this might be where you want to go long, okay? I'm not going to short something just because it's in this pattern, because you could have shorted it yesterday or the day before, and guess what? You're not making money. So it's not a reason to short a stock. You want to short stocks that are breaking down, like P. See that? That's a downtrend. When it rallies within the downtrend and into a moving average like the 10-day, like it does here, actually here it runs into the 20-day, but there's resistance here you can see in the pattern along these lows. You come after them on the short side. That's what you want to be going after, because what's happened, and if you read our book where we talk about, you read our book, Chapter 6, you also read the book I wrote for Bill ONeill, How to Make Money Selling Stocks Short. These stocks have long moves, okay, because institutions are piling into them all the way up, and then finally when that flow reverses, even in something that's as big an institutional favorite as Apple, they top, and that's it. And the money just flows out of them as steadily as it went in, and that's what creates a big, beautiful downtrend that you can sell short into. Let's see. Dr. K, here's a question for you. Are you ready, Dr. K?
Yeah, shoot.
Okay, we don't get much Euro news lately. Does the Greece 5% bond offering indicate that the Eurozone is recovering? Okay, put on your mental masturbation cap and answer the question.
Yeah, I think I sometimes just leave it on for the duration, depending on the day, but and how bored things are in the mobile markets. But right now, if you look at IEV, which is the iShares Europe ETF, that's been showing a lot of strength compared to other markets.
What's the ETF, Dr. K?
IEV.
IEV, okay.
And that's been showing a lot of strength. iShares Europe covers a number of the major European bourses. So, prior it was more of a laggard. So it's saying that perhaps things are, or the theory is that things are recovering more so in Europe. But again, it's splitting hairs. It's not like this index is off to the races at all. You could also take a look at EWU, and that's the UK ETF, and that's showing more weakness. Yeah, I mean, there are signs that things are getting a little bit better in Europe, but the overall sign is whether it's really coming out of this recession or not. And I just see global problems all over the place still. I mean, it's trying to project when the recession's really going to come to an end and things are really going to be at a much better level. It's nearly impossible. I mean, a year ago things were supposed to be turning a corner, and these things kind of get put out greatly delayed in their timeline for lots of reasons, because there's so many different variables that can enter the mix. So it's not going to make you money to try to figure out
whether a bond issue is that.
Yeah, when is Europe when are they going to recover? Are they really recovering? It's better to just look at key names that are coming up in your screens, and if you're using the MBM, then use the technique of strength begets strength. So you're going to be buying indices that are showing more strength than others. So on a buy signal, IEV would be possibly viable as an index of choice, although on a buy signal I'd probably prefer a more volatile but major index like the Nasdaq Composite.
Yeah, my view on if I'm going to mentally masturbate on the Greece bond thing, the 5% bonds, as far as I'm concerned, what it means is they found a bunch of suckers willing to throw their money away for an alleged 5% annual coupon payment. So that's the way I look at it. I wouldn't put.
Yeah, and there's your additional variable. See, there's lots of different layers and meanings behind actions.
Yeah. Okay, Dr. K, you can go off on the UVX model. I got to answer the door real quick. I think I got a delivery. So go ahead and talk about this for about a minute, and I'll be right back.
On the UVXY, yeah. Basically, that is much more volatile. As members know, it's the kind of model where in some cases some members will take profits off the table if the model has been up 20, 30, 40%. They don't have their own risk tolerance levels that they apply to the model because it is so volatile. The track record that's shown is really it's not that meaningful simply because it is so volatile. And there was a signal where the model is up over 50%, and I know got lots of emails about that. Should I take profits? Well, yeah, there's nothing wrong with taking some profits, especially with that kind of a gain in such a short amount of time. But that applies to everything that we do. If you've got a winning stock on your hands, but you're in a very uncertain market environment, yeah, you might want to take some profits off the table. Trade around a core position in that name. You could do the same thing with UVXY. You can say, look, this thing's way beyond my normal volatility level. So if it goes down a certain amount or up a certain amount, I'm going to either cut my losses or capture my gains. There's XIV and SVXY. These are the volatility ETFs. And these are naturally volatile, and so the thing of it is, though, is that as the markets go higher in this QE environment, these things have done very well despite the volatility. And so what I've done, and I mentioned this before, is I'll trade around a small core position in something like SVXY with the idea that if I'm going to add to the position, I'm going to be very quick to reverse that addition, just so that my core position, in other words, will continue to go higher. So with something like SVXY, I've had that for over 6 months, and it's showing pretty nice profit, especially in this kind of market. Especially if you want to just be less aggressive about your trading and rather your frequency of your trading, and you want to just sit on something. Now, in this current environment where the markets are coming off a hell of a lot, I still have my core position in this thing, but on the other hand, I did have an additional position which I then brought back to cash just to take the profits off. And this core position I have, it's a small portion of my account, but I'm still sitting with it all these months later until I see, you know, some particular reason to get rid of the core position. I'm probably going to sit on it as well. Now, if this thing also is, if the market were to have an Armageddon situation, I would sell that core position, and I still should be up on the trade because I've made money along the way in the core, but also trading around the core. So it's important to be nimble when you're dealing with anything that involves volatility, especially the UVXY model. Gil?
Yeah. Okay. Well, that's that. I don't deal with
that was that. I mean, just handle it with kid gloves and lots of mittens.
Somebody says, so, by the way, congratulations on your new book. Well, there is no new book just yet. We still have to write the thing, although we have started out, started the work for it. And I'm holding in my hands right now, actually, the contract from Wiley. Dr. K, did you get a copy of this?
Yeah, I did.
Okay, yeah, so we'll be signing it. Well, I got to read it over the weekend, and we'll be signing it next week, and then we'll be off and running. So we ride again. But they're very excited about it. They didn't even put it through their committee. They just said, yeah, we want it. So, because we sell, I think we do honest work. We're not perfect, but we do honest work, and people find it useful. At least they have. It's a fact because we've sold a lot of books, and Wiley loves us. So, it is what it is. But, thanks for the congrats from everybody. Appreciate that. Somebody asked, do you carry positions over the weekend? Sometimes I don't. There's no hard and fast rule. So on the short side, I can tell you I've been holding a short position in LinkedIn for a while. I think the stock is eventually going below 100. That's, maybe I'm crazy. But I have been holding a position, at least some kind of position in it for a while. So on the short side, even through all these bounces. So actually I did cover it under 160 and then put it out again. So there's a couple days where I wasn't short it. But all the way down over the last week or so, I think I've been holding it. But let's see other questions. Oh, by the way, remember we were looking at in real time. We're looking at Gilead when it started to break down here, and as we're moving lower, you got a 620 sell signal. So when this was happening, we had a little rally here. Right into here, I was putting the position out as a short, and now we're starting to come in. So that's how I'll handle this, adding to what I put out on this MACD stretch. So now we're kind of getting some downside velocity. I think the thing will reverse, so I'm feeling good about that so far. Not quite a buck on the position right now. Somebody says, I don't have any intelligent things to ask here, but just want to thank you guys for all your guidance and helping me enjoy my best week in my short 5-year trading career. That's great to hear.
Next time.
Let's see. This is one of the few days that I've been able to catch a webinar live. If you come back to the old days and move it to after hours, that'd be great. Actually, we never did do it after hours. I do on occasion have a weekend webinar like I did on Sunday, a stock hunting webinar, if I think that it's a crucial time and it can be useful for everybody, and I think that Sundays actually was. Some of you hopefully can vouch for that, but if you don't believe me, just go back and look at the video. GLOG. You want our opinion on it? Yeah, here's one that's moving up. These guys transport gas, but these are this is where the money is going as it goes to the back end of the Titanic, which is up in the air and still out of the water. Somebody says, I think McClellan does the same sort of thing. I think this is with respect to precedence. He imposes a current market action on an old pattern, works until it doesn't work, but a lot of money can be lost, FYI. Gil, time for a new acronym, RTFB. Read the freaking book. I'll remember that one. Gil, point and figure chart on P shows target of 18. So it's gone to 18. Last I looked at it was 19, but that's fine. That works. Sunday's webinar was very timely and helpful. So, well, you guys, I mean, I think everything, most short sale targets, unless you're seeing something rallying up into a moving average where it becomes shortable. Yesterday you had to be on the ball with, say, Pandora. Up in the 30 level on that rally, also LinkedIn up into the 10-day, and now they're coming in. I think LinkedIn is probably going to head for these lows, and we'll see what happens. My view is it's going to go lower, so I'm running a pretty decent-sized position today. We'll see what happens by the end of the day, how much of it I cover, how much of it I decide to hold, if any, over the weekend. But things are looking pretty grim here. Gil, are the REITs possible leaders after this correction? No, I don't think so. I think there's just money going into them. I'm not sure why, but I don't see them as leaders. I think the whole real estate thing is an illusion caused by easy money policies, and eventually that's another bubble that's going to pop. So, market hovering about the lows. Where are we at, Dr. Hayward? Yeah, we're hovering over the lows right now on the Dow, and the S&P, the Nasdaq, just trying to push through the lows. I think the intraday low was 40.18. You're at 40.21. It looks like you're going to go lower. So, there's nothing to buy. If you're really concerned, you got your panties in a bunch about what you're going to buy when the market turns, first of all, I would say, let's see the market turn first, okay? Number two, show me what's acting right and what's in a buy position when it turns. And I figure we'll see that when we start putting out pocket pivot alerts on certain stocks. In August of 2010, we had just started up the website, and I remember we were putting out pocket pivot alerts on CMG, Chipotle Mexican Grill, Lulu, Lemon was another one that was showing pocket pivots. There were several. There was a networking stock, Ariba Networks was popping, and that was looking good. And I actually talked about that on Fox. I think it's actually on August 29th or 30th. But, you'll see them, and we'll see them, so you'll see the alerts. And there's no reason to try to anticipate anything. So just let it unfold as it's going to unfold, and, we'll figure it out in real time. Anyways, that's all we got. It's 11:03. We've been going for an hour now. Gil and Dr. K using an NBA saying, "You're fantastic." Thank you, Dr. Q. You're too generous, as always. But a gentleman as always. And that's all we have. So we'll catch you guys next week, and we'll see where this market goes. But I don't think things look very good here. I think you're headed lower for a major sort of crash-type break to the downside before you bottom. So, and I think the Nasdaq gets to the 200-day before you see that happen. So if you're short, for example, watch the indexes as well. I always keep one eye on the indexes because the other day, for example, in the S&P 500, like LinkedIn went under 160, so it hit my undercut level. P came down to the 200-day, and so that was right at the time that the S&P was at the 50-day. And I figured that's where you would see a bounce. Then you would get a chance to see how weak or how strong the market was at that point, because if it was weak, it would roll over. And I actually thought you might get a 3-day rally. Instead, you get 2 days and 2 and out, and you're done. So that's what it looks like. Anyways, you guys, thanks for showing up as always. Good luck. And remember,
So long, everyone.
you don't need to know what's going to happen. You just need to be watching what is happening. And watch for our alerts in real time. So we'll catch you guys later. Take care. Have a great weekend.